So this is chapter 24, which talks about the valuation and uses of futures. And this video is going to be a brief introduction into what a future instrument is, what's the difference between a future and a forward, and basically then we'll move on to how we go about valuing a futures contract or the value of a futures contract. So what is a futures contract? It calls for the delivery of a specific instrument, a specific financial instrument, at a specific date or period of time for an agreed upon price. Okay, so all these things are set. It's what asset is going to be delivered, what date, and what time. Okay, as well as what's the specific price that we've decided. So now there are also things called forward contracts, right? Now, what's the only difference between a forward contract and a futures contract? A forward contract has its profits and losses settled at the end of the contract. Okay, so if it was a 90-day contract, you'd not have anything go on in the middle, and at the 90th day, you decide to settle the profits and losses to either side of the party. Okay, versus in futures contracts, the profits and losses are computed every day, right, on a day-to-day basis. And this day-to-day basis is called marking the market. Okay, marking the market. So every day, whatever profit or loss happens decides the money that flows, the cash flows between the different parties. Okay, and so there's more of a cash flow sequence happening for futures than for forwards, and that's basically the only big difference between them. Okay, everything else, they both call for a specific instrument, specific date, specific time, with a specific price, but the forwards only take a look at the profits and losses at the end of the time period at the maturity date, versus futures, the profits and losses are done on a day-to-day basis. Okay, within a futures contract, so when I say futures, I'm also talking about forwards. Okay, basically, they're almost everything is going on in the similar fashion. Okay, so the terms that are specified within a contract are specified in detail. Okay, it would say how much of the asset, what type of asset we're trying to deliver. Okay, what's the maturity date? How long does this contract last for? Okay, in the exact place and process of delivery of that asset. Okay, so whatever asset you are talking about in that futures contract, a stock, a bond, etc., etc., you would discuss about how that asset is going to transfer hands between two parties. Okay, now in addition to those guidelines that are set, in addition to those factors that are listed out in detail in the contract, there are other things also set by the actual exchange upon which the futures contract is traded. Okay, the margin is stated, as well as there are some limits placed on the trading. Okay, so what's the margin? The margin is the amount of funds that each party must set up. Okay, it's sort of like an insurance, basically. Okay, that they're asking both sides of the party to put in some money beforehand in order to ensure that the transaction will take place according to how it's supposed to be. Okay, so it's basically to ensure that both sides follow through with the transaction. Okay, so it's the amount that the exchange requires both sides of the party to put up in order to be able to engage in that transaction. Okay, and it's just to ensure that both sides follow through with that transaction. Now, there are also limits on the size of price changes that can occur in a trading day. Again, the size of positions taken. So, if the price of that underlying asset changes by a very drastic amount, trading basically stops. Okay, and then you're not able to exercise that futures option. Excuse me, not option. To exercise that futures contract in that day. Okay, because the trading is essentially stopped once that minimum limit has been crossed. Okay, now what are the two main terms that we're going to be using a lot? We're going to be using this term called long and short. Okay, long is the purchaser of a futures contract. Okay, somebody who purchases the futures contract is said to be long in the futures contract. Okay, now the writer of the futures contract or the seller of the futures contract is said to be short in the futures contract. Okay, so basically you can think of it as purchaser long, seller is short. Okay. Now let's assume that we're gonna have one contract, okay, one contract for government bonds for delivery in 4 days. Okay, where the textbook talks about 10 days. I'm just gonna do it in a 4 day sequence just to show you the differences between a forward and a future. Okay, so the price is listed per thousand, so the settlement price is actually per thousand. Okay, so when I say 66, I'm talking about $66,000. Okay, $66,000. So we have a 4-day maturity, so we're counting down -3, -2, -1. 0 is the date of maturity. Okay, how do these prices move? So let's say the settlement price on day -3 was $66. Okay, somebody bought it for $66 at $66, and somebody sold it at that settlement price. Okay, now at day one, so the next day after the contract is purchased, which would be also -2. Okay, the next day over, uh, the price changes from 66 to 67. Okay, now here's where the difference happens between and a forward and a futures contract. Okay, so in the forward, nothing really changes in between. Okay, there is no cash going on. Everybody just forgets about that contract until the last day when the maturity happens, and then they decide what happened to the change in price. Okay, versus in the futures contract, things are changing every day. Okay, cash is flowing between parties. Okay, so let's look at the forward section first, just to understand what's going on, and then we'll continue where I left off with the 67. Okay, so if we bought it at $66, and on the date of maturity the price was $68. Okay, the price of the contract. You actually, if you bought that contract, if you went long on that contract, you made a $2,000 gain, right? Because it's a 66 to 68, which is 2, but it's 2 per 1,000, so we multiply that times 1,000, so it's $2,000. Okay, now at the same time, the person who went short on that contract actually lost $2,000. Okay, because the price went up from 66 to 68. You're able to buy it for 66, and so they're gonna have to sell you a product that's worth $68,000 for $66,000, making a $2,000 loss. Okay, so the overall profit and loss, if for a person who went long on that futures contract, on that forward contract, is $2,000. Okay, the long made a profit of $2,000. The short on that futures on that forward, excuse me, the short on that forward contract is minus $2,000. Okay, as you can notice, it's a zero-sum game. Okay, if the person who went long made a profit, that's at the expense of the person who went short. Okay, the person who shorted that that forward or futures contract, basically is losing exactly the same money as the person who went long on the futures or forward contract. Okay, so no changes happen in between. The only change happens on the last date. Okay, on the maturity date. Now let's look at the futures area. Okay, on day one, the next day, which is also -2 for maturity, the price went up from 66 to 67. Okay, on that day, the price is settled. That's a $1,000 gain for the person who went long on that futures contract. Okay, and that's at the same time a $1,000 loss for the person who went short on that futures contract. Okay, now the next day, the price actually dropped. Okay, from 67 to 65. From 67 to 65. Now, this is a $2,000 loss for the person who's long, okay, because the product has dropped from 66 to 65. So the person who is long in the futures contract actually made a $2,000 loss that day, okay. But the person who went short in that futures contract made a $2,000 gain that day. Okay, now in the next day, the price changes from 65 to 68. Now this is again a gain for the person who bought the contract, okay, who went long on the contract. It went up by sort of $3. 3 times 1,000 is $3,000. So that is a $3,000 gain, a $3,000 profit for the person who went long in the futures contract for that day, okay, only the day of maturity. The person who went short on the futures contract made a $3,000 loss that day. Okay. Now, if we sum up all these numbers, we see that it's 1,000 minus 2,000 plus 3,000. You end up with the same number that you had with the forward. Okay. If you went long, you still make a $2,000 profit, whether you did a forward or whether you did a futures. Now, if you went short, you're going to do the same thing. Okay, you add up all these numbers, you're going to get a minus 2,000, which is the same kind of loss you would make if you also were in a forward contract. Okay, so basically, there's no difference between a future and a forward if you just consider the beginning day and the end day. Okay, whatever happens, the final profit stays the same. Okay, the final profit or loss stays the same. However, the futures contract has some cash flows in the middle, okay, some intermediate cash flows, which could change the valuation um, of those contracts. Okay, there's nothing going on here in between in a forward contract, but there are cash flows happening in a futures contract. Okay, so that's basically how cash flows work in a futures forward sense, and we will move on to valuation of futures in the next video.